A money market fund is a form of unit trust. This type of fund invests in short-term, highly liquid assets. These products include cash, cash-equivalent securities, and high credit rating, debt-based assets with a short maturity, such as treasury bills and commercial paper. This fund is suitable for the low-risk, cautious investor who prefers stability and security for his or her investments. Interest is calculated daily and credited to the client's account of net costs. A money market fund is not to be confused with a money market account. A money market account is a type of savings account that pays interest. Financial organizations provide money market accounts. A money market fund is an investment that is managed by a fund business. As a result, there is no guarantee of principal. It is considered the least risky of all the unit trusts since invested capital is never lost. Money market funds are required to follow financial authorities' requirements when issuing redeemable units or shares to investors. These funds invest in short-term, high-grade securities traded in the money market to maintain a steady net asset value. The price of the debt instruments which have been invested affects the value of the shares. They must maintain a high degree of asset liquidity to fulfill daily redemptions from their investors. Due to their tight linkages to the banking industry and other financial activity, MMFs are considered systemically significant institutions. Furthermore, because MMFs are a major source of business and government funding, a run on funds, i.e. huge withdrawals from MMFs, during a financial crisis might have significant macroeconomic implications. They are frequently used as a substitute for bank deposits because they provide investment diversification, immediate liquidity, and relative value stability. They are seen as a relatively safe option for short-term investment of significant sums of money. They are also a major source of short-term funding for the actual economy. They purchase short-term money market instruments such as treasury bills, commercial papers, and certificates of deposit issued by financial institutions, governments, and companies. Money market funds are used by investors who desire a cash-like investment. These investments may yield a minor profit while posing a low risk. Compare that to a portfolio that is heavily invested in equities. Switching to a money market fund or retaining a part of one's assets in these products can typically lower risk. They are frequently liquid, which means you can usually pull your money out within a few business days. A mutual fund sale usually takes one trading day to complete. Following that, you may need to transfer the cash to a spending account. You may issue checks to withdraw money from a money market fund at some institutions. As a consequence, you benefit from both dividend profits and simple access to your funds. Over time, these funds may pay greater or lower rates. If an investor expects interest rates to climb, keeping their money in a market-sensitive investment might be a good idea. They could expect money market funds to deliver modest long-term returns because of the logical trade-offs between risk and reward. One can't predict how much money they'll make as the future develops. Money market funds are thought to be safer than other types of investments, such as stocks. Over time, inflation can eat away at earnings, so one should look for higher-yielding money market assets. Money market funds are used to momentarily park money before investing elsewhere or making a cash outlay. They are not ideal as long-term investments. The interest rates offered on the different instruments that make up a money market fund's portfolio are the most important criteria in determining the fund's overall performance. It's enough to look at historical statistics to get a sense of how money market returns have performed. Money market funds are popular among investors as a haven for cash until they decide on other assets or for short-term liquidity requirements. They provide a diversified, professionally managed portfolio with high daily liquidity to clients. This is why money market funds have evolved into one of the most important components of today's capital markets.